Just one second. Okay, fine, guys. Let's start. Who are there? Okay, nice. Okay, so as Ishika is handling bucket 2, right? Applied AI for business, and Anvesha is handling PDS probably. So this is for bucket 2, but they will guys might find this session interesting, so that's why I'm teaching this. So okay, let's start. Just confirm if my screen is visible. Okay, can you see? Okay, just one second. All right, so this is not like not directly related, but you can actually use this knowledge for like case studies or for projects and everything, or also to have a better idea about the domain you're going to handle. So, okay, so today's topic is introduction to financial analysis. So, sorry. So in this yeah. So today's topic is introduction to financial analysis. So what is financial analysis? That I guess I don't need to explain. You can use any gibberish intro like analyzing the way like the methods to analyze financials or financial projects or find like like how to handle P&L and everything. This could be a form of financial analysis, or you can take say you can predict stocks and other stuffs. So just like I'm skipping the intro, I'll just give you some brief idea as I got to know most of the people are unaware about this. So okay, let's proceed. So these are the finance like toolkit that you are supposed to have, that you are supposed to hold this skill set for like to perform financial analysis. One is familiarity with financial tools as in say different ways, different tools for making to grow your wealth, or different tools to earn money, to exercise, to invest and stuff. Then you need to have some computational knowledge. Math tools also you're supposed to uh, be familiar with, and this is very trivial analytical skills. Obviously, I like as you have studied data science or you are in the field of STEM, I guess that is trivial that most of you will be having that. And then econometrics. What is econometrics then? So econometrics you can say just one second. So econometrics is more of a like matrix plus economics. So basically metrics that are used to measure something which is related to economics. So economic metrics, you can say it like that. So now I have chosen the easiest topic, that is mutual fund. So many of you might be wondering what is a mutual fund? Because this nowadays we are like we hear this term a lot, like everybody be it what's like be it any social media or maybe in general in news also, everybody talks about investing these days. They talk about stocks, they talk about different stocks, something. And MF is the most common term that you'll be hearing. So what is a mutual fund? So consider it as a, okay, is my pointer visible, by the way? This, is it visible? Could anybody confirm?
Yes.
Hello?
Yes, it's visible.
All right. All right. So it's mutual fund as in fund as in a sum of money, a collection of a lump sum of money, right? So a collective wealth or something you can consider as a fund. Now that has been hosted, that has been collected, or that has been governed by multiple people mutually. So in a simple way, there are say n number of people, say people 1, people 2, people 3. So you can see that there are multiple people. So first person, maybe they contributed 1 lakh. Second person, maybe they have contributed 2,000, and another person, they have contributed 500 or something. Okay. So they are like creating a consolidated fund mutually. So that becomes a mutual fund. Now, what do we do with the mutual fund? So first, so we, as you know, that like we don't have much money, like we can contribute very little, as we are known as retail investors who do not actually invest directly, but they follow, like they use the retail market to, because of the easier entry, because of the lower barrier of entry, because you cannot, like most of us cannot actually gather or accumulate crores, maybe 1,000 crores or 100 crore. So that's why what we do, we collect, like we create a consolidated fund. So now this mutual fund, this consolidated fund is being used to buy different stuff. Say like you have this bowl, consider this mutual fund as a bowl. Now in this, some of the money has been invested to stocks, some of the money has been invested to securities. What are securities? Securities is like, say, some company has taken a loan from a bank, and now they have like to, if what happens if the company is unable to pay their debt and stuff. So as a security, as a, you all are familiar with security amount, I guess. So as a form of security, as a form of collateral, they give, or they kind of like delegate some assets owned by them to the fund manager. I'll get back to you regarding this term, fund manager. So these are securities. Then maybe with just 1 second. Let me check. Anvesha, Dadani, Ishika, and Moshwita joined. She left. She mentioned she has some network issues. Right. Yeah. Hello. Only 4. Okay. Yes, Anvesha.
Nothing.
All right. So and then you buy from that amount. So like you use some of the amount to buy precious metals like gold, silver, silicon, or any other things, and then bonds. What are bonds? Bonds are like a contract given by the issued by the federal government, or issued by the say GOI, Government of India, or any government body or any public institution. So just 1 second. So these are like basically like you give loans to the corporates or funds in form of securities. So I'm kind of generalizing it so that you guys can understand in a better way. So this is a form of contract from the government, where the government be like, okay, fine, you have given us some money, and we'll take this as a loan, and then after some tenure, after some fixed tenure, maybe 5 years, 8 years, 10 years, or maybe 15 years, we'll be returning this amount with like with some interest, which could vary between 7% to 11, and sometimes even like you get 13. This varies. So we don't have that much money, right? So what we do first, okay, first, so who makes this decision? So what happens is that every fund has a manager. So the manager is very experienced, and they have a diverse set of experience in this field of finance and investing. And what we do is, from this consolidated amount, we pay that guy, and they have huge salary, and we cannot actually hire them personally. That is almost impossible. So what we do with that consolidated money, we form a trust, and then we let that trust hire a fund manager, and that fund manager decides which like how much money we need to put in which segment and stuff. So as I mentioned, they are very experienced and they get a huge cut. So that's their advantage. Why would they take care of your investments? Why would the manager take care of your assets and everything? Because they get a cut, and also they get a salary. So mutual fund, consider it as a, say, chimney, and where, like, you have seen, I guess, in Chinese restaurants, they kind of like serve these chimney pots over the plate, and then you can actually live cook. So you can see that there are different segments and people are cooking different stuff here. So this is the fund. And then from here, we have been diversified. Like, there would be salad, there would be, say, salami, there would be sweets, there would be dumplings and stuff. So this is how we diverse stuff. Okay. So enough of basic intro. Now let's get familiarized with the key term. So first is AMC, or Asset Management Company. So basically, this is a corporate entity or a corporate company that actually creates this fund. So initially they pay, and they kind of like send a proposal that, okay guys, we are creating a fund, and they start marketing that. So there are, like, you are already familiar with some names, I guess. BlackRock, I guess many of you are familiar with. There are some other companies named Vanguard. These are international players. In India, we have HDFC Asset Management Company. We have ICICI Prudential AMC. So this company, this is a government, this is a private body or a corporate body who are responsible for all the operations, like whatever you are investing, or even like marketing to make that fund popular so that more people invest in it, and also the management services. So initially what happens, first some sponsors sit together, and then they decide, okay fine, we need to create a fund. And then the sponsors together, they build this AMC, or Asset Management Company. And then there is a like this AMC is sort of a trust. So now what they do, this trust, also this AMC. So I told you that we hired a manager, right? So this AMC, this body, they are the person, they are the entity which is responsible to actually hire, make all the decisions, or handle all the operations related to your fund. So what they do, this AMC charges us a fee, and then from that fee they do their marketing. They hire staffs, and then they make decisions, or they pay for their infra, and so on. So this fee that has been charged by the MNC, that AMC, is called expense ratio. This is another key term. So till now we have learned two key terms, which are, one is AMC. Pardon me, it's wrong side. Okay, so we have learned one term, that is AMC. And then we learned another term called expense ratio. So now let's dive down into fund managers. So your fund can have one or more fund managers. That's why individuals appointed by the AMC. So they are the, as I mentioned, they are the one who makes day-to-day investment decision for a specific fund. They are the brains. They do all the hard work. They do the research. What we do is we pay them the money, and from that money they take a small or whatever cut. Like, compared to the size of the entire fund, they take a very small cut. Now it's more of a like, so it's more of a like, see, initially we have sponsors or investors. We have, say, investors. This you can consider people like us. So we are sending out money to the AMC. The AMC is hiring a fund manager. Now the fund's money has been distributed into stocks, bonds, real estate, precious metals, loans, and other stuff. And just 1 second, guys. Okay, so every fund has an objective, and it is the fund manager and the trust's responsibility to make that happen. Every fund has a goal, every fund has an objective. Some funds are meant to make short-term profits, and the rest are meant to make think for long-term goals and stuff. So the fund manager's performance is directly related to the success of the or the failure of the fund, because again they are the one who decides that how much shall we put in stocks, how much shall we put in bonds or other securities, how much to buy and when to sell, etc. And then what happens is that you are not actually lending money to the AMC. Like whenever you are say this is a AMC and say this is a AMC and you are putting like other multiple people are putting fund F1, F2, F3, and this is not like you are not paying this to the AMC. So what the AMC has a proposal or a structure like say 20% to gold, maybe 30% to index, 40% to stocks. Now this is a very generalized way of explanation, whatever. So whenever, so they have this entire conglomerate, and then what they do, they kind of divide this into multiple units, smaller units, so that retail investors like us can buy in a fractional price. So it is a considered it as a fractional ownership of the entire fund. So basically you buy some units of the fund. It means you have a contract or you have a document which states that you own a certain part of the certain fraction of the assets. AMC is different, they have different shares, but whatever this fund has been created by the AMC, in that particular fund, where the fund has been diversified into multiple financial tools and stuff, in which into like you own a certain unit depending on as per as the specifications of whatever they have invested and everything. A proportional ownership. So if the total asset is say this here, so if it's 1 crore and there are around 1 lakh, 10 lakh units, so then total fund by number of units, you get the NAV. So that is the price of each unit of the entire fund. So now we have another new term, that is NAV, net asset value. So consider it as the total market value of all assets in the fund. So this could be like, so wait. So maybe this fund has invested into, like bought a property. I'll say they have bought a house. I'll use a single example of 2 crore or something. Okay. Okay. Our funds, like maybe something like they bought a car, or maybe they bought gold. So they bought gold. They, they bought gold of say 1 lakh rupee, and then after that it got inflated after 5 years, maybe into this. Okay. And then total liabilities and expenses. So initially maybe there were one staff, and then they now for them they used to pay 25,000 salary, something, just these are random. And then after 2 years, maybe currently, initially they started with this, now they have 3. Now they have 3 people and they are paying around maybe 25, 50 or something, their total In total, they are paying 1 lakh as salary. So 1 lakh for 1 crore 50, sorry, 1 lakh 50,000 minus 1 lakh. So this is your difference, 50,000 by total number of units outstanding. So maybe that is say 70 or something. So your NAV value would be 50,000 by 70. So now this is a very interesting part. Unlike stocks, stocks change every day. Okay, stocks change in the value of a stock changes in every second, by each second. But in mutual fund, the catch is like as it has been invested into multiple sort of assets. So which are stocks and also gold and real estate and stuff. Okay. Hmm. Yeah. So we calculate, or the price of this has been calculated only once per day. Okay. Now let's assess, or let's learn about, like, revise the key terms that we have learned till now. AUM is the total value of the total consolidated value of the assets. So it gradually increases or decreases, whatever. So this one rule of thumb or rule of observation is that if the size, the OM is very high, that means many people trust in that fund. Many people have been invested to that fund. So there are like for, let's check. Okay, so if a fund, like if the AUM of a fund is very big, so as an example, right now, I'll give you some examples too. Okay, so say for, let's talk about liquid funds. So I'll explain what is a liquid fund later. So for ICI Prudential liquid fund LQ, so the AUM is around, I guess, 50K CR. So that means what can you imply by seeing that? Like, what can you infer by seeing that a fund has a very high OM? That like this fund is highly likely to be disbanded, or like highly likely to be closed or stuff. Because if there are multiple people and if the asset size is very big, then even if they need to sell something, or even if somebody defaults, if say I have already mentioned, right, we are buying a lot of assets, or we are also buying bonds, or we are giving loans to different companies. Say for some company, they defaulted, they couldn't able to pay. Then like if I have a big fund, then to compensate for that, I only need to use, or I only need to expend a very small percentage of the fund, and then also the fund, like overall the fund will be intact. So that's why a fund with a high OM is very trustworthy sort of. Again, this is, none of these are advices, by the way. These are like a general way of explaining this. So please don't follow these and like make investments. And if a fund has very small OM, that could be like the fund is very new, and also this fund can invest in smaller companies who has a very less requirement, and this fund can grow. There are two possibilities: this fund can grow, and also maybe like the fund is only of say 100 crores, but if it has been invested into a company which requires like 70 crore, it has given debt to somebody who has 70 crores. Now if you need to sell this asset in some like during a tough time, then after you sell this, you'll only have 30. You will be losing 70% of the asset, right? So this funds with very small AUM can go up, has the like hint of reward that it can grow bigger. So if a fund is small, then your NAV price, your per unit price was maybe very smaller, 10 rupee, and now it can grow up with a NAV of like 30 or 300 something. Again, it can go into not zero, maybe 7 or something. So the bigger the cap is, the lesser the risk is. Now, however, again, this fund, like the fund which has 50k CR, that won't grow that much compared to this fund. If there are two funds like here and there, this can come up to this, but this is already saturated, so it won't go up. Now, the second key term that we learned is expense ratio. I discussed a bit. So it's a percentage. It is expressed as a percentage of the fund's asset. Like whenever you're paying 10 rupee to the fund, or maybe investing 500 to the fund, they mentioned like this is our expense ratio. ER is maybe 0.03 or 0.07 or something. So it's a percent. So whatever you're paying from that, this percent has been deducted to and been paid to the AMC. Okay, this is an annual fee charged by the AMC for managing the fund. Managing as in, say, the salary of the fund managers, marketing, admin costs, infrastructure costs, and other stuff. And also there are two different types of investment. So I forgot to mention. So one is direct, another one is regular. So in the first one, you invest directly. Okay. So trivially, it has a lower expense ratio. Like you are paying less amount of fee to the fund. And then regular as in between AMC and you. So it's more of a contract between AMC and you directly. AMC, me. So we don't, and in a regular plan, there are different entities, intermediary entities, maybe a broker, a firm or something who is handling it on our behalf. Now they might have some sub companies. Now this all might have some agents, A1, A99, somebody. So your expense ratio will be high. So these people, so initially it was 0.3, right? Now these people may be getting 0.7. These people may be getting 0.4 or say 0.6. These people are maybe getting 0.2, like the total cohort, and so on. So if a fund has an expense ratio of 1%, it means like you are paying ₹1 per 100 from your investment. Now this is a stay flat cut. This directly reduces your total gain, total possible wealth over like throughout the year, like throughout the overall tenure of your investment. So the more the expense ratio is, the lesser the return would be. So the rule of thumb would be the lower the better. So like you can understand that, like if you compare two funds, if like both of them have the same growth and one of them has a lower expense ratio, that means that is much better. Now what is exit load? So this would be the last term for today. So exit load is like, so you have charged, like you have paid the amount to the AMC, maybe 1 lakh, 2 lakh, 1,000, 50 rupee, 100 rupee, whatever. So if you put your money out before a certain period, that varies with respect to the type of the fund, type of like the AMC, it varies from fund to fund. So now if you sell your funds, if you take their money out before a certain period, so they have like before you invest your money, they'll give you a contract where everything, or like it is directly mentioned in the fund. Every fund has their web page and everything. So there you can check what is the expense ratio. So if you take that money out before a specified tenure, stipulated time, so then they charge, they kind of like take a cut or kind of like add a penalty from that, like, and they'll return your money, but they'll take a short penalty, like this could be 0.21, 0.25. Highest, according to SEBI, the highest would be 0.25, I guess, for exit load. Usually it's very less, like sometimes it's 0.0007 also, it depends. So why? Basically, it actually discourages you to put your money out in a very short term for short term investments, because most of the people actually lose money. and it actually helps you to promote, it actually helps to promote a culture of investing for long term. And also there's one fact, I don't know if you know, like, so suppose if there are 100, 1000 people invested in a fund, now 10 people withdrew. Now they are owning, somebody who has 6 units, somebody has 7 units, somebody has 100 units or whatever. So after they sell their after they take their money out, this units we still have, right? This units are still uh, like the AMC still have these units, right? So what happens to those units? Like maybe after 10 people left, you have 300 units extra. So what happens is that this 300 unit has been divided by, so what happens is that this 300 unit has been divided by the rest of the people. So after 10 people have left, there are around, just one second. So 990 people. So this extra fund will be divided and added to the portfolio of these people. Okay, so this would be all for today. Tomorrow we'll be discussing, like in the next class for bucket 2, we'll be discussing about how many different funds are there. And then after that, there will be a task and I'll give you a roadmap, and we'll be creating a project. We'll be working on a project to create a fund analyzer. There will be 4 modules for that, and I'll share the diagram and architecture with you. All right, so this would be all. If you have any question, you can ask or we can conclude.
Hello. Hello.
Hello?
Yes.
Go on.
I have a different question.
Go
Not
on. Regarding the class? Regarding the class?
No, 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 no.
Okay, then we can, I'll have a conversation later.
Okay.
All right. Anything else, guys? Okay, fine. So we can conclude. Thanks for joining.
Thank you.
Thank you. Bye.